Good morning and welcome to this Monday, November 16th, 2020 edition of Trading Places Live at Earnings Beats. I'm Tom Bowley, Chief Market Strategist here at Earnings Beats, and I'll be your host for the next 30 minutes featuring everything you need to know as you prepare for the trading day ahead. Well, it is another Monday and it's another positive vaccine coming out. News from Moderna this time. Last week was Pfizer. This week it is Moderna, and we are seeing a similar reaction. That same rotation that we talked about last week. We've got the Dow futures up 400. We got the NASDAQ futures down 42 last time I looked. So we've got all of the stocks that did well during the pandemic looking like they're going to be under pressure again today, while you have stocks that were hurt during the pandemic that now are looking ahead to life beyond the vaccine and, well, beyond the virus. Vaccine not quite here yet, but it's close. And so we got a little bit different market, different rotation. I think that's going to set up quite differently for the market over the next 3 to 6 months. Do want to point everyone first over to Earnings Beats. So let me pull that up for you. Hope everybody had a good weekend. All right, you can see here, left side of the page, you can sign up for our free newsletter, the Earnings Beats Digest. Name and email address, all it takes. Don't worry about credit card, no credit card required. You can unsubscribe at any time. Here is our performance and our portfolios. I can tell you that the last week portfolios have struggled because we have been following the growth versus value uptrend, which has not been in play of late. A lot more attention, a lot more money has been rotating into value, and that will impact our draft, what I call our draft, which is our every 90 days, we fill out our 4 portfolios with 10 leading stocks and 10 leading industry groups. And that leadership is changing. And I think this upcoming draft will certainly be reflected in that change in leadership. But that'll be on Thursday. Tonight, we actually have a special webinar for our members to talk about the rotation that's taking place. And it looks like we might get another day of it today. So we'll have to, certainly keep an eye on what takes place, not just at the open, but throughout the day and throughout the week. But there definitely seems to be this rotation. I'll talk about a little bit more in the show. But later today at 4:30, all of our members are invited to come in for what I think could be a game-changing webinar, very similar to the one we had back in April, where we identified that we really had 2 different markets going. We had a bull market in many of the online areas, stocks that were benefiting from a lot of things moving online. And then we had a bear market in the run-of-the-mill companies, the brick and mortar companies that people weren't going into because of the virus, the airlines, the recreational services groups, a lot of the, hotels, gambling, anything where people congregate, get together in closed areas. Those types of companies did not do well, but they are beginning to shine. And you can look at the numbers, the earnings, and say, well, Zoom and Peloton, they're blowing their earnings out of the water. And, Wynn Resorts and, United Airlines, they're not, doing anything. But the market's looking ahead. It's not looking at what the last quarter just showed. And so I believe the market is beginning to look beyond this virus. And beyond this virus, it doesn't mean that Zoom and Peloton aren't great companies, by the way. I think they are, and I think they'll continue to do well. But they're being priced for perfection and for tremendous growth, while other companies are being ignored. And so a lot of money has poured into those stocks. And I think it's just demand and supply. It's, really, it's just the basics, economics 101, if you will, that as money rotates and more folks are interested in the Wynn Resorts and the MGMs and the Disney Worlds and those types of companies that have been ignored for so long, those other companies that have been doing well are just going to suffer as a result. And I think that's what we're seeing right now. We're going to talk a lot about that later today at 4:30. If you want to be part of that, if you're not already a member at Earnings Beats, we do have essentially a free trial for 30 days. And if you join now, it'd be a great time because we do have 3 member events coming up this week. We've got tonight's rotation webinar. Then we've got Tuesday's Max Pain. We're going to look at options and the impact that options might have this week. And with all these changes taking place, that could be really interesting as well. That's going to be tomorrow. And then Thursday, as I mentioned, that will be our top 10 stocks webinar where we will essentially be drafting the stocks that we're going to hold for the next 90 days. And you can see here our performance, even with the recent lagging performance, the model portfolio is still holding on to a 5 percentage point advantage this quarter. You can see over the last 2 years, well, it'll be 2 years on Thursday. Over the last 2 years, we're up more than 120 percentage points over the S&P 500 by following this method. The aggressive portfolio doing very well. This quarter, though, because of last week's rotation, aggressive portfolio, really, there's been a lot of volatility in that portfolio this quarter, hence aggressive. But it fell behind early, came roaring back, took a big lead, and now has pulled back because of this latest rotation. Income portfolio hasn't been doing very well. We'll have to try and tweak some things, maybe see if we can up the performance in the next quarter. But then the strong AD has been on fire, 16 percentage points above the S&P 500. So anyhow, all of those stocks will be announced on Thursday. So if you want to be part of that, the rotation tonight, the Max Payne tomorrow, and then the Thursday top 10 picks, just simply click on this Join Today button. 30-day, you pay $7, but we refund it to you within 5 to 10 business days. So essentially you get a 30-day trial at no cost. So it's a great time to come on board. We'd love to have you. Let's move on to what's going on in the market, or what went on in the market on Friday and last week. It was, like I said, beginning of the week, it was rotation. We saw the Dow, the S&P, mid caps, small caps, all, moving higher. The S&P 500 hit an all-time high, and that's kind of the benchmark that I follow. The Dow Jones, if we pull this up, get a closer look here on, we almost hit 30,000 for the first time ever. That was back on Monday. We gapped up. The high was 29,933.83. I believe we're going over it. Might be today. I believe we're going through 30,000. I'm on record. I'm very bullish the market. Even in this last quarter, when we did the picks for the portfolio, I said I'm comfortable the market's going higher. The part that I'm having the problem with is what groups are going to lead. How long are these pandemic stocks, the ones that are benefiting from stay at home and social distancing, how long are they going to lead? I think we're beginning to get our answer now. Anyway, Dow Jones up 400 points on Friday. The S&P 500 up 48. That, by the way, was the highest close ever. So on Monday, we got up as, we were at 3,600 and change. We opened well above 3,600, and then we sold off most of the day. And the high close of 35.80 was back here in early September. So Friday's close of 35.85 was the highest close that we've ever had on the S&P, eclipsing that September high close by 5 points. The NASDAQ up 119 points. I think this is where the NASDAQ's going to begin to struggle. It just seems like the market, as I said, we're looking ahead. All of a sudden now we're getting all the positive vaccine news last Monday, now this Monday. Who's it going to be next Monday? Seems like that's when we're getting the big news right now. But it's positive news. I mean, I think everyone's tired of what we've been through over the past, 8-9 months, and we're ready. We're ready to move on. And some of these vaccines, I think, are giving us that path and that avenue to do just that. Mid caps up 43 points, more than 2%. Very strong action. Small caps up close to 2.75%, 2 2/3, up 26 points. Closing at 994, trying to get back up above 1,000. It's been a long time since we've seen the small cap index up that high. The energy group led on Friday. Crude oil has been bouncing back as the news comes out with the vaccine. I think that's hoping to spur more and more demand for energy, oil prices. They've been on the rise. So anyway, energy up 3.6% on Friday. Real estate, a little bit more than 2.25%. Industrials just under 2.25%. This is a group I really like. Industrials, I'll be talking about them a little bit more in the show. And then also later tonight, I'll spend quite a bit of time on the industrials. The hotel and lodging REIT was your best performing industry group on Friday, up 8.5%. We went up, we tested that June high. We haven't gotten through it yet. Again, I think it's just a matter of time. This hotel and REIT index is part of, or hotel and lodging REIT, I should say, index. This is part of my pandemic index, one of the 10 groups that really was hit hard during the pandemic back in March and April. And I've been watching them closely. We're getting close to a breakout in the pandemic index over the June high. I'll show you that in just a minute. And I think the hotel and lodging REITs, this is going to be one part of it. If we get a breakout here, that's certainly going to help. The renewable energy space, struggling a little bit. It was one of only 2 industry groups that were lower on Friday. Water index was the only other industry group that was lower. Now, when you look at this, you can see the highs here. Look at that PPO coming down. We got a negative divergence. I really like this group going forward, but I think it just needs to consolidate a bit. I think that's what we're going through. You can't see it here on this chart because it's blocked, but this last high that we had back in late August also was accompanied by a lower PPO on this move. And you can see what happened. It wasn't like we went into a bear market, but we struggled for a period of time. And I wouldn't be surprised to see maybe another 5 to 7, 8% off of this index, maybe test that 50-day moving average. That's what I'd be looking for. Watch the recent low down here, just below 170. I think that could be an area that we gravitate toward on the renewable energy. All right, as far as economic reports out today, only one significant. We had the November Empire State Manufacturing Index out. It came in at 6.3, which was lower than expected. The expectation was 13.5. That 6.3 reading for November was also lower than October's 10.5. But I don't think the market cares right now. I think the big news for the market is this vaccine. We now have 2 in play. And you can see right here, 10-year Treasury yield up today about 1.5 basis points, almost 91, 0.91%. And the company that came out with the news, Moderna, pull up that, the pre-market, see it's up 14% pre-market. Now, the interesting part about Moderna and some of these others, some of this is built in. Now, you can see Moderna got as high as 95. Looks like we're going to break above that here. I don't know, probably 103, something like that. I don't remember now what I was just showing. 102. Okay, 102, up 14%. So it does look like we're going to break above that prior high that was set back in July. And of course, the high that was back in May. So we are getting a breakout here, but a lot of times it's buy on the rumor. You can see Moderna has been doing very well over the last couple of weeks. A lot of times it's buy on the rumor, sell on the news. And we saw that back in May on very heavy volume where we were moving up, gapped up with news, and then sold off. Don't be shocked if we get a sell-off after the news. A lot has been built in to Moderna. And, there's been a lot of talk throughout the pandemic that they're developing, fast-tracking a vaccine. They come out 1 week after Pfizer, but, Dr. Fauci and many experts have been saying we need more than one, and having more than one obviously is very beneficial. So again, more good news for the market. Honestly, I think the one thing that really held the market back, and it's quite obvious, was the virus. I mean, we were sitting at an all-time high in February of last year, and I was on record saying I thought the S&P 500 was going, I used 40-40 in 2020. That was my target, 40-40. And then, of course, 2 months, that was back in January. And then 2 months later, we get the pandemic that kicks in. And we went all the way down to 2191. And now, when you look at the S&P 500, it's kind of like we're there again. I mean, we're getting close. 35.85, looking at, I don't know, another probably 50 points or something at the open, 40, 50 points. We're going to be back above 3,600. All of a sudden, 4,000 doesn't seem that far away. I mean, 10%. But if the beaten down parts of the S&P 500 really start to rally, that 10% might be doable. We may still see 4,000 this year, which is shocking to me. I think it speaks volumes as to the secular bull market that we're in, that we could just kick aside a virus where we had to shut down the country basically for a month, and still the S&P 500 comes back and maybe, possibly, gets back to 4,000. If it doesn't happen this year, it's going to happen next year. I feel pretty certain about that. That's just my opinion. But I believe the market's going a lot higher. I'm on record also of saying, and this was back when the S&P was sitting around 3,000, but I said we were going to triple. I figure we'll be at 10,000 by the end of this decade on the S&P 500. I'm very, very bullish about the market continuing to move higher. And if you just look back at what's happened, the S&P 500, if I pull up the last couple years, go back 3 years, But look at what the S&P has battled. This was the trade war, remember? We were up over 3,000. We went all the way back down to 2,350 or so. 20% drop. Rallied right back. 4 months later, we were right back at the high. Then we have the pandemic, 35% drop. 4 or 5 months, right back at the high. What's going to take this market down? Think about it. If the market's not going down with a virus that shuts down the economy for 30 days, and the market's not taken down by our trade dispute with one of our largest partners in the world, what the heck's going to take this market down? And by the way, interest rates are at historic lows, and the Fed says they're going to stay there. You know, I've done valuations in the past. I know how to value companies. And everybody talk about, well, PE ratios are this high and that high. PE ratios, a lot of the PE ratios are dependent on interest rates. Tell me the last time interest rates were this low and earnings were growing, and earnings are expected to grow. We've never seen it in our history. Anybody sitting on the sidelines because PE ratios are too high, I think are going to be in big trouble chasing this market when things are much higher, because earnings are going to grow rapidly. And as a result, PE ratios will start to come down, but they still deserve to be much higher because of the low interest rate environment. You can't look at earnings back in year 2000 when the 10-year treasury yield was at 6% and expect the earnings to be valued the same in today's environment. You had alternatives back then. It wasn't worth the risk of whether or not these companies could meet their growth projections, because you could go into bonds and earn 6%. That was a great alternative. What are you going to get into now? How are you going to make your money if you're not in stocks? If you're not riding this growth wave to the upside, how are you going to make money? Going to jump into those 10-year treasury yields and make your 0.9%? Probably not. All right, couple things taking place right now, and this is really important, I think, in terms of the rotation. When you look at this chart, this is the IWF, IWD, and I know I'm on record of saying, you know, I'm not ready to, you know, really reevaluate until we kick out this 1.69 level right here, because that was the high here, and if you just start marking highs, that's A, B, C, D, E, F, G, H, I. And so we still haven't really come down to J, or you can number it, you know, 1, 2, 3, 4, 5, 6, 7, 8, 9. Well, until you go back and take out 8, which actually on an intraday basis went back to about 1.68, 1.69. Until we lose that level, we haven't reversed this uptrend. So there's that. You can still ride the coattails and say, well, you know, we haven't broken down on this yet. And that part's true. But we're definitely, I mean, that would be the last piece, because we're already, look at the PPO. That's the relative momentum. We are at the lowest level. We're at almost -1. We have not been at this level for 2 years. So value relative to growth is at its highest momentum. It's got the best momentum it's had in the last 2 years. So yes, we haven't broken down yet. Maybe that happens today, though, with, you know, that the bifurcated action that we have in futures right now. I wouldn't be surprised. A lot of things are starting to point to this. All right. And then let's see, there was one other, let me show you this chart. So this is one I wrote. I don't remember if I put this in the weekly portfolio report that I sent out to our members yesterday, if I wrote about it at my blog at Stock Charts Trading Places. But this is a pretty big deal. Here is, I've put a invisible chart. That's what I've pulled up here. So it's not a candlestick. It's not a line chart. It's an invisible chart. And an invisible chart just means the data, the daily data on the IWF, IWD does not show here. The only thing you're seeing are the overlays, which is the 20 and the 50-day EMA. So I used EMAs for both. I usually use SMAs for the 50, but I went ahead and used both. And the 50, if you use the SMA also, we've gotten a crossover, the 20 below the 50. But here I was using the EMAs. And you can see for the first time in 2020, and really for the first time since back, you know, maybe in September of last year, we've seen this turn negative. But that relative momentum is at the weakest level it's been in almost 2 years. Really since December of 2018. And that's when we started to come back from that trade war. That was actually maybe a little bit of a sign that that trade war wasn't going to last. I hadn't even looked at that, but you can see the momentum in the growth stocks was actually starting to turn higher in December of 2018 when prices were going lower. That was kind of interesting. But now we've got prices going up, S&P showing all-time highs, and now we got this ratio going lower. It's pointing out that, hey, you've got a potential problem because momentum is shifting. That we can stick with the Zooms and the Pelotons and all these companies all we want, but if the market begins to shun those groups and those stocks, we're going to be behind the 8 ball, and that's not what we want. We want to follow strength. I'm not married to Zoom. I think Zoom's a great company, but I'm not married to it. If it's not going to perform well, or if I don't think it's going to perform well, or if the market's telling me other areas are going to perform better, then those are the areas that I want to really concentrate in. That doesn't mean I'm not going to include Zoom, by the way, on Thursday, because I still think Zoom's a great company. I think it's a paradigm shift that has created a tremendous opportunity for this company to be a leader in a growing online space. I don't believe people are just going to rush back to work. I don't care how effective these vaccines are. I think people have gotten used to working from home. I think companies are seeing how efficient and effective this has been to still get work done. Employees aren't on the road traveling 30, 40 minutes to work, maybe an hour, hour and a half in some of the big cities. This is kind of a big deal. So I really like Zoom going forward. I'm going to be evaluating it. I'm sure I will stick with some growth names just in case, but it's probably going to be much more of a mixture than it's been in the past. But that right there is a problem. I want to show you one other chart that I think is really interesting. So bear with me while I pull this up for you. This is another chart that I showed. Again, I'm not sure where I showed it, but I showed it in one, either in the weekly portfolio report that I did yesterday, or maybe it was in a blog at Stock Charts. But this is the pandemic index that I referred to. So what I've done, if you go to Stock Charts and go to just their dashboard, there's a, on the left-hand side under the reports or tools or whatever, there's a user-defined index. And so I've been keeping track of data for 10 of the worst, well, the 10 worst performing industry groups back in March and April. Those were the groups that were hit hardest by the pandemic. Those are the ones Wall Street said, we don't want any part of these. And I put those 10 groups together. I equal weighted them in an index that I've been tracking. And so here's the pandemic laggards is what I call them, but here's the pandemic index. Look at the March drop. In April, we came back to a low, almost tested that March low. The market didn't do that, but this pandemic group did. And look in May, even though we've seen a big rally in the overall market by May, we weren't that far off of the March low in May. And then finally, we got the pop on June 8th. And then as the market, look at the market keep going higher. This is the S&P down here. See the market making this big push? Look at the pandemic index. It was way down, even though the S&P had gone higher. They were still lagging. But at this September high, while the S&P has been going through all this sideways consolidation, there's something else been taking place under the surface of the market. And you've got to do your homework to spot this. CNBC is not going to tell you. Look at the pandemic index rising while the S&P has yet to break out. So we're seeing leadership in the pandemic stocks. We're beginning to see those groups lead. And that's really important because I think this is a group that has the potential to go up just as fast as the pandemic. You know, the stocks that did well during the pandemic, you know how fast they went up and how our model portfolio outperformed. All of our portfolios just crushed the S&P 500. Well, I think it could be the flip. I think we could see some really nice strength in some of the value areas based on just putting the whole puzzle together. That's what the market's telling me. That's what Wall Street seems to be saying at this point. And so while a lot of folks will be looking at Zoom saying, wow, Zoom's a great deal, and Peloton's a great deal, Wayfair's a great deal, DocuSign's a great deal, maybe some of them bounce back. Maybe the market goes back to all those. Maybe we're going to have a lockdown and everything goes back, but that's not what Wall Street is positioning for right now. And that's my point. Again, we're going to talk a lot about this later at 4:30. So make sure If you're a member, tune in, or we're going to record it. So if you can't make it, it's not a big deal. We'll make sure you get a copy. But if you're not a member, I'm telling you, there's never been a better time to join. This week, between tonight's rotation webinar, tomorrow's Max Payne, and Thursday's top 10 stocks for filling out all of our portfolios, I think it's a great way to get. I think the value speaks for itself. You're paying zero, so you don't even need any value for it to make some sense. But anyway, be sure to check that out. I'd love to have you join us tonight. All right, let's go back to the other chart. I'll get ready to wrap this thing up here. Do want to talk a minute about earnings. A couple of stocks came out with their earnings this morning. Things are slowing down. We still have companies coming out. We'll see a lot more retailers reporting soon. And by the way, I think we're going to get some really good news out of some of these online retailers for this holiday season. I think we'll probably see some big gap ups, maybe a stock like Wayfair. But I would be using that strength. If we continue to see this money rotating to value, I would use these big pops to think about lowering your position and lowering your exposure in those areas, just based on what we're seeing right now. But JD.com, remember when it was pulling back here? I actually wrote a EB Digest newsletter report. And if you're not a member of that, a subscriber to that, that's free Monday, Wednesday, and Friday. But when this stock was pulling back, it was back in September. I wrote about it at some point, because when it was pulling back, see the AD line going up? This stock's in an uptrend. It was pulling back, but AD line was going up, telling me that it was being accumulated. As people at the top, traders chasing, were selling, institutions were gladly buying. And that's why we saw gap downs and then recoveries and the AD line going higher. I really liked JD back then. It's come back nicely, set a new high, tested the 50, went up near new high, just reported earnings. Stock was down 3%, I think, this morning. So it's down a few bucks. I think anything back down close to that 20-day or 50-day makes a lot of sense, just my opinion. But JD did beat on their bottom line, 50 cents versus 43 cents. I think that stock looks pretty interesting, even though it is down this morning. Palo Alto Networks, PANW, stock's up 5% this morning. They blew out their earnings, 162 versus 134. You can see stock up very nicely. Looks like we're going to get a breakout there. Tyson Foods. I mean, everybody following these PE ratios. Tyson Foods expected to come in at 115. They came in at 181. And we've seen a ton of companies like this throughout earnings season. They're not beating by a couple of pennies. Many of these companies are blowing the numbers out of the water. Now, part of it is because the bar was set so low. The estimates were being lowered on a lot of these companies because of the pandemic. And what we're seeing is that these companies are coming back much faster. And so if they're projecting growth and they're beating numbers like this, if this is how Wall Street is valuing these companies based on Tyson Foods earning $1.15, and now they're coming out at $1.81, if they say good things about the future and they raise their estimates going forward, the company deserves a higher multiple. Tyson is up 4% pre-market. It's one of these companies that's really struggled during the pandemic. Eventually watch that 68 level. I think if Tyson gets through, and I believe it will, this is a company that should do very well as we close out 2020 and move into 2021. Last stock earnings, ACM, this is ACOM Technology. They beat 60 cents versus 57 cents, stock up a little over 1% in pre-market. This is a company that did take out that June high and starting to show some pretty nice strength. It is in one of the best areas of the market right now. This is a group I will be talking about tonight. This is the heavy construction, DJUSHV. Look at the group making a breakout above the February high. It went sideways for a bit. Here in November, as things are changing, this group is benefiting. Look at the relative strength, really since July, but it's picked up here, October, November, with that surge, vaccine news, pulled back. Now we're rising again, likely to get another pop today. This group looks really, really strong to me. So DJUSHV, we're gonna wrap this up with a couple of the three you must see. I'm gonna start right here with the DJUSHV because there's your breakout. Very, very nice move. AD line just simply going sideways. I'd like to see that pick back up again. I think we will. Let's see, what else did we have here? There's another group I was thinking about. Let's pull up the charts. Whoops. That's not what I wanted to do. All right, now let's go down here to industrials. What was the other group I wanted to show? Oh, commercial vehicles and trucks. Look at the relative strength in this group. So this is your second three you must see. There's your commercial vehicles and trucks. Look at the breakout and the straight up move. Wall Street is seeing the economy up ahead growing. These are groups. This is stock. These are stocks that are growing earnings. It's not just that they're growing earnings. You really can't lose sight of the fact that we are in an interest rate environment near zero. Valuations are done by taking future earnings and discounting it back using current interest rates. When current interest rates are as low as they are right now, you basically are not even discounting. You're just taking future earnings. It's I don't know how to emphasize it anymore. Stay away from the PE discussion. This is not about PEs. This is not about looking at PEs and comparing to 5, 10, 20, 40 years ago. To me, it's apples and oranges. Unless you can show me a period, maybe back in the 1960s when we had rates, the early 1960s when rates were pretty low. Maybe you could start to compare then, but so many of the dynamics of the market are different now than back then. So I'm not even sure that would be a good comparison. But anyway, so that's the second chart. And the third chart I just wanted to show you, I'm going to move over to the sectors because I know John wrote about this in Chart Watchers over the weekend, my partner, John Hopkins. But look at the industrials. First, there's the absolute breakout. Look when it occurred with the vaccine news. It was already doing well. It was already showing relative strength. The vaccine news, though, is throwing it over the top. Industrials are a place you want to be looking in the market right now. I feel as strongly about industrials right now as probably any other group. Just because they were beaten down for a while, now their earnings are likely to pick up and accelerate. And I think the market is going to price that in, going to start price. It already has begun, but I think there's plenty of room to the upside in industrials and many of the groups within industrials. All right, that's it for today. Please come join me tonight. Such a big, important discussion. Dow Jones right now up 335, S&P up 24. I thought the S&P would be up a little higher than that. NASDAQ down 7, NASDAQ 100 down 35. We continue to see this rotation. I'm looking at some really good companies that are on this list of the worst performing S&P 500 companies right now. Etsy, PayPal, Clorox, all three of those stocks are in our portfolios. So our portfolio is definitely taking it on the chin right now. But hopefully we're ready to right that ship come Thursday. All right. That is it for me. Everybody have a great day. Hopefully see you later tonight, 4:30. If not, next Trading Places Live episode will be tomorrow over at Stock Charts at 9 a.m. Everybody have a great day. Happy trading.